Bank Nifty is trading at life highs, so there is a record high in the session today, and watch out for that particular part of the market because that is propelling the indices higher. We're all through the last few days we've been talking about what other sector which in the large cap space comes to the fore and takes the market higher. Now we're seeing first signs of the Bank Nifty participating. 2 days on a trot now. The banks have been doing very well and really good going. Thanks for tuning in to Talking Point. I'm Niraj Shah, and our guest today is Ajay Tyagi, Head of Equity at UTI AMC. And Ajay, thanks so much for taking the time out and being with us. Can I start off with a subset of the market because the Bank Nifty is doing what it is doing, is trading, has hit life highs today. 2-3 days on a trot now, they're participating. Is this the market trying to get different legs into the fore and banks having not rallied coming to the fore? And are you constructive on banks currently or not quite?
In fact, I would say that this is the only part of the market which has been trading at valuations lower than the average of the last 5 years, 10 years, even 15 years. As we are all aware, most parts of the market are trading at a premium to the historical averages. If you break up the financials, I would say the private sector banks in particular haven't really participated in the rally at all. Public sector banks have still done well. But as a composite, I would still agree to your view that this is that one subset of the market which hasn't participated, and valuations are certainly in their favor. Business models are as robust as they were in the previous decade. Credit growth, to my mind, will track slightly higher than what it was over the previous decade. So I think most vectors are favorable, including valuations.
So for the longest time, banks per se, at least private banks, haven't quite done well. 4 years on a trot now, we've had underperformance of private banks vis-a-vis public sector banks. Is it time that they might do, can this reverse, if you will, or do you reckon both PSU banks and private banks could do very well in times to come?
See, as things stand today, let's look at two things which are very important for banks. One is, what's the situation on the non-performing assets? Non-performing assets today for the banking system as a whole is at a multi-decade low. The second thing, which is a second order impact on banks, is how's the situation of debt for corporate India. So debt to equity for corporate India also is at a multi-decade low. And the third thing is basically what's the view on growth. Like I mentioned, credit growth seems to be fairly strong going into this current decade and would track slightly higher than what it used to be in the previous decade. So from that perspective, I think the layout for both private sector banks and public sector banks is strong. Now comes the relative play between the two. And I would say here that while PSU banks certainly are much better placed compared to what they were starting 2010, 11, 12, when we saw the beginning of this crisis in terms of NPAs in a lot of these infrastructure sectors, power, roads, and so on. So that baggage is not there. But the valuations are clearly tilted in favor of private sector banks. I mean, in the last 2 decades or more, I would say that we have never seen private sector banks trade at a premium to PSU banks as low as it is today. There's hardly any gap, by the way. So I think that itself, to my mind, tilts the equation in favor of the private sector banks.
Okay, so you do reckon that private sector banks, by virtue of all the things that have happened in the past and even now, deserve to continue to trade at a premium to PSU banks?
Absolutely, yes. Absolutely. I mean, there's a world of a difference in terms of their core operating metrics. Look at just one operating metrics which condenses everything together. Return on assets. Return on assets for the best of breed PSU bank in the country, which is SBI, is 1.1. The return on assets amongst the large private sector banks is in the ballpark of 1.8 to 2%. So that just tells you everything.
Okay, fair call. The other thing is other financiers. A lot of people, like today we were talking to somebody on the buy side who was talking about how relative to private banks, maybe financiers, maybe insurance companies, maybe some of the capital market plays might be better placed for a retail investor. Not a fund which is, let's say, have to meet benchmarks, but per se, if I'm agnostic about the benchmarks and if my pool is not very large so that liquidity is not as big a concern, buck for buck, non-lending financials give a better probability of gains versus private banks as well. You second that?
See, I'll be slightly tentative here, Niraj, and there are multiple reasons for this. One is that I think we are still not very sure about the regulatory landscape on these non-lending finances, because essentially we're talking about insurance companies, we're talking about asset management companies. And we have seen some bit of regulatory headwind on both of these subsectors for some time now, the latest one being the insurance sector. That's point number one. Point number two is that, you see, when it comes to private sector banks or certain large PSU banks, you're really talking about financial conglomerates here, which have multiple engines of growth. By the way, many of these asset managers and insurance companies are also part of these financial conglomerates. So I would say that the better way to actually participate in financialization of savings as well as credit growth in the country is being a long-term investor into some of these institutions. So I would prefer that. When it comes to asset managers, please don't forget there is this huge debate of active versus passive. India is at least a decade behind the developed markets. In the developed markets, passive has gone as high as 50%. That has consequences on yields and profitability. So we will get there at some stage. So there's going to be a slow burn on our profitability. But this is the global trend, and I don't think India can defy that global trend.
Okay. So viewers, the first point is that today's talking point has to be about what banks are doing and how they're coming up. And Ajay Tyagi, head of equity at UTI AMC, believes that the time may be ripe for private sector banks to actually now start a period of outperformance relative to the public sector banks as well. The Nifty bank has hit record highs, and the reasons are many, as he's just outlined. But principally, the premium that the private sector banks enjoy over PSU banks is the lowest in the last 2 decades, if I'm not wrong. And therefore, that is enough reason for private sector banks now to get a serious look, if you believe that financials are going to be the key sector going ahead. Now, just a word really, financials are scaling up the markets. Every single day, we are hitting new highs, so to say. At some point of time, I mean, people will say that the naysayers were negative at 21,500 also. They are negative at 23,500, but there's a chasm of difference in valuations between those two levels, right? At these levels, do valuations spark a serious concern about a further up move in the markets?
So minus the adjective that you used, I would say yes, it's a concern.
Serious. Okay.
So I would say rather than being economical with words, our view at UTI has been that the valuations at which the markets are trading today does load the dice unfavorably for investors, at least from a 12-month perspective. Look, when it comes to investors who are looking at a 5-year horizon and beyond, we always say that stay invested, you can't time the market, it's almost impossible to get in and get out. But it certainly appears to us, given where the valuations are, given where the excitement level is, given where the F&O participation is, so there are these multiple things which are indicating to us that valuations are unfavorable right now. We won't be surprised if markets correct 10%. We won't be surprised at all if markets move sideways for the next 12 months, because the valuations are suggesting us that. So, I mean, if I take the valuation picture aside, I would echo what most other people have been saying, which is that India hasn't been as robust in terms of its fundamental outlook ever. The only weak link is the fiscal deficit, and I do hope that the government would be addressing that. There's a glide path that the finance minister has committed the country towards, and I hope that we will be sliding down that glide path.
I thought that with the RBI dividend in play, that is not a question at all, Ajay?
Life changes sometimes within 24 hours. It wasn't a question at all pre the political outcomes in this country, but post that, it does appear that the government may have to loosen their purse strings. They may have to actually dole out money for, let's say, bottom of the pyramid. So it may have some strain on the fisc. The good news is tax collections remain robust. So that's why I'm saying that given the puts and takes around this equation, looks like we would be able to still adhere to the glide path.
Okay. With an assumption that all of that happens, is the market, and with the earning growth assumptions that you might have for your portfolio companies per se, or the overall markets maybe, because you're benchmarked to the index, Ajay, would you be a confident buyer at a lower level, or would you be a buyer after a period of time if the market were to consolidate? Because earnings will catch up at some point of time in the next couple of quarters too, right? To the multiples.
Sure, that's a good question. And Niraj, essentially, we're trying to reach to the same level. If there is a price correction by 5-10%, it makes the equation favorable. If prices don't correct but remain sideways, but in the meantime earnings catch up, it again brings the valuations down to a more favorable position. So yeah, essentially we're talking about the same. And my answer would be that whether the markets correct outrightly or they consolidate and therefore there is a time correction, our comfort levels would increase.
I get your point. Okay. Now, it may well happen, Ajay, that the markets may consolidate, but specific pockets may do well. I mean, everybody wrote off defense. The stocks have been on steroids, really. There, I don't think you will tell me to mask my words because really the sector has gone through the roof. But my limited question is, let's assume that the markets are consolidating sideways to maybe minor corrective move as well. Where is it that you believe the chances of outperformance is higher based on either policy, based on earnings flow, or based on flows that the market may be seeing, given the promise that the sector may hold for the future?
Sure. So, the way we always approach the equation is that we are always oriented more towards the outcomes of businesses rather than trying to take a view on where could the flows, land up. Okay. So we are usually, not usually, I would say we are always oriented towards, do we understand this business? Do we understand the outcomes of the business? Do we understand what's going to either hit the business or it's going to act as wind in the sails and so on? Now, from that perspective, I would say that there are 2 or 3 quarters of the market which look positive to us. We've already spoken about the banking sector. And we did talk about the sector in detail. Valuations are favorable. The construct in terms of growth per se is as strong as it always was. The second sector which we think should now be favorably positioned is the consumption sector, which has many facets. It has consumer durables, it has consumer discretionary, it also has consumer staples. Now, consumption has been weak in this country, and we all have seen the dissected GDP data, which talks about the consumption leg being very poor all through the last, I would say, almost 8 quarters now. 2 things. One, what we've observed in India is that consumption, while it's a structural growth trend, but it too does have its own cycles. We feel that consumption today is at the bottom of this cycle. That's point number 1. So regardless of the exogenous variables, consumption ought to be witnessing an uptick. Point number 2, I think, again, let me go back to what happened at the hustings and the outcomes of that. I think the government does realize that they've actually put in a lot of money behind infrastructure, rightfully so. It has the maximum multiplier impact, but they also cannot neglect the consumer part of the economy. They cannot neglect the consumer at large. So our feeling is that they would be, the government will find ways to put money into the pockets of consumers. That would be the immediate impact on revival in consumption and the different facets that I just spoke about. By the way, valuations in this sector compared to their historical averages are at par or maybe slightly lower in certain pockets. So I think this is the second one. The third one, where we feel that there is a very strong structural growth story and yet valuations are not at crazy levels, is the healthcare sector. And here too there are multiple dimensions to the healthcare sector. We have the pharmaceutical sector, which is very domestic oriented. We have the hospitals, where the government has realized that, look, we can't spend as much money as the private sector hospitals can, and therefore we must support them. We also have a small subset of healthcare, which is diagnostic companies. And last but not the least, we have discovered that China plus one can be a big opportunity for a lot of these export-oriented players who can partner with the big pharma. So I think that's another sector where we are finding opportunities. I'm not saying valuations are very attractive, but the valuations are not outlandish.
Okay. Well, talking about the bit of a here and now as well before we hit that break. Remember, as we've said, that banks are in the thick of things, but telecom is in news as well. Let me get in my colleague Rucha to talk about the big development in the telecom space today, which is the Vodafone Group divesting the stake in Indus Tower. Rucha, what updates do you have?
Thanks, Niraj. So Vodafone has divested 19% stake in Indus Towers, and it now holds around 2% stake via Indian entities. So it has sold its entire holding via its foreign entities. Now this involves a cash flow of more than 16,000 crore rupees, and now Bharti holds the highest stake in Indus Towers of around 48%. Now the use cases for Voda Idea from this cash flow could be number one. Now it had pledged this stake in Indus Towers against a bank borrowing of 4,500, which is the cap number. So this stake sale would likely involve the repayment of this bank borrowings. Number two is that the payment of Idea's dues to Indus, which is capped at around 6,500 crore, could also be paid off to Indus Towers, and this could involve more cash flow to Indus Towers. Now Indus Towers has not paid dividends since May 2022, and brokerages believe that this increased cash flow could enable Indus Towers to give dividends to its shareholders. Also, UBS believes that $500 million of this entire transaction could be infused in the Vodafone business by the company. So yeah, so Indus Towers likely will give more dividends. That's what brokerage house believes.
Got it. Okay. Well, that's the view on telecom as well. So that's the other sector in focus. Ajay, very quickly before we take that break, any thoughts here?
So I would say this sector is undergoing consolidation, as we have all seen over the last many years. I think what's important to realize is that the sector is regaining pricing power. While this transaction that we are just talking about may actually lead to Vodafone getting that lease of life, because perhaps it gets in the money to actually put in for capex and therefore retain its subscribers. Remember, they have been actually witnessing a subscriber churn significantly over the last many quarters. But the fact is that the two remaining players are now big by a big mile. It may well remain a three-player industry, and if you count the government-owned BSNL, a four-player industry. But then there are two large players, which means that the industry is fairly consolidated. It will behave almost like a duopoly with pricing power. So I think that's the big picture view that we hold on telecom. Yeah.
Now, Ajay, I mean, really, what's happening here? I mean, the dips are getting bought into, stocks are getting marked up as if the returns or the earnings are gonna come over in the next maybe 6 months. It's crazy what's happening to the valuations there. Yes, there is an order book, but execution deserves some thought. Are you concerned about the valuations, or do you believe this is fine?
No, I would say certainly concerned about the valuation. I like the catchphrase that you use, that defense sector is no more the defensive part of the market anymore. And we truly believe that. I think there is a lot which is being built into the prices right now. Expectations from this sector are sky high. I would say, just to put things into perspective, yes, the government has made the right effort in terms of bringing to life this sector. It fits into the manufacturing in India or make in India theme that this government has. It also fits in very well into the export opportunities, because yes, many of these defense companies are exporting to African countries, certain Asian countries, Latin American countries. But we again go back to what is built into the expectations. Fundamentally, can these businesses continue delivering 15-20% kind of growth year after year for decades together? There the answer is no. And I think that's where there could be disappointments along the way. Fundamentally, the sector in terms of its outlook has certainly improved, but the pendulum has swung to the other extreme, and therefore people feel that these are businesses which will just continue growing and growing into the skies and delivering numbers like high teens for decades together.
So would you be booking profits in defense if you had them in your portfolios?
I can't be very specific, Niraj, on stocks, but yes, I would stop by saying that the valuation of the sector is not giving us any comfort.
Got it. Yeah, I didn't want to be specific. I understand you have those constraints, but I was just wondering that if somebody added, I mean, would you book profits as well? But yeah, valuations not giving comfort is a fair answer as well. Okay, the other aspect is autos and just the way they have done. Now, just before I get Ajay Tyagi's comment on that, Tata Motors becomes in focus too, because we've had the Hyundai IPO. There's a conversation on Maruti and hybrids, and Tata Motors today has given the JLR JV's Investor Day presentation from yesterday, quick snippets as well. Puneet Johnson for 1 quick minute to give us some idea of what JLR had to say. Puneet.
Yeah, thanks for that. So very quickly, just we know the FY24 numbers. It was the highest ever revenue, EBIT margins as well as profitability for the company. But I just want to focus on what they've guided for the next couple of years. Mainly on FY25, they have said that the company will become net cash positive, which we've seen in the India entity also becoming net debt positive. So that is guided for JLR as well going forward. In this particular financial year of 2024, they had 0.7 billion of debt, 0.7 billion pounds of debt. So that should get down. On revenue, they are expecting to cross another roughly 30 billion pounds of revenue. EBIT margins are going to sustain around the 8.5% to 9% range, and this is expected to increase to 10%. The company has said that they will be, maximizing their EBIT through special products and launches such as the Range Rover SV and the Defender. Going forward, the key number is on free cash flow, which has historically been a problem for the company. Is expected to be around 1.8 billion pounds for FY25 and increase on that for the next fiscal year. And finally, on product launches, the Range Rover Electric, the much awaited product, is expected to launch next year. They already have a waitlist of 38,000 on the same. And the new Jaguar, do note on Jaguar, they had mentioned that they will electrify the whole product range from the next fiscal year. And they have said there will be a jaw-dropping moment as stated by the company's CEO. And they will be also launching their first ever electrified modular platform for more further launches as well. Back to you.
Thanks, Puneet. What about autos, Ajay? And in that same breath, auto ancillaries as well, because some of them have this defense angle too. I mean, companies like Bharat Forge have this industrial angle too. Just trying to understand, how do you look at this theme?
I'll take the second part of your question first. I think it's easy to get this out of the way. Somebody buying auto ancillaries from a defense perspective, I think, may not be making the right decision. Even if you talk about many of these companies which have been participating in defense, the fact is that out of their overall revenues, defense is at best 10-15%. So if you really are bullish on defense, it's always better to pick up companies which have 70-80% of their revenues coming in from defense. So that's second part of your question. In general, the auto space, yes, we are bullish. It fits in very well with the theme of very low penetration in India for passenger cars, even two-wheelers. And the fact that increase in per capita income is only going to increase the penetration of particularly four-wheelers in this country. So I think it fits in very well with this theme of higher disposable income, improving the overall penetration and therefore rendering growth for the entire sector. It will have second-order impact on ancillaries as well. Do remember that ancillaries have also been exporting over many decades now. And therefore, this China plus one that we keep talking about can benefit many of these ancillaries as well. I must also mention here that for some of the larger players in the country, and here I'm talking about passenger vehicle or passenger car manufacturers, exports has become a very big opportunity already. Look at Maruti, look at Hyundai. Many of these players are also looking at exporting to nearby geographies. So I think overall, we remain constructive. Valuations here, slight premium to history, but nothing which is burning red. We ought to be slightly cautious, but then, in this context of the overall markets themselves trading at 15-20% premium, I would say auto companies are also in the same ballpark. So nothing outrageous here.
Nothing outrageous here. Okay. Well, on that note, out of time completely on this leg of Talking Point. Ajay, thanks so much for coming to our studios and talking to us. Really appreciate your time.
Lovely. Thank you.
Yep. And viewers, thanks for tuning in this edition of the Talking Point.